Hi, I'm Nishant and I welcome you to the FinLatix Financial Markets Experience program. We're really happy to have you on board with us and we hope you enjoy it as much as we enjoyed crafting it for you. This is the training module as part of the FMEP curriculum. This module will help you in both your portfolio management as well as your research work. Feel free to make notes from this module and also to take cues from it. Don't forget to implement it in real time on the stock simulator present on finlatix.com. There would be 6 training modules as part of the FMEP curriculum. In these modules, we would be covering a range of topics like Introduction to Financial Markets, Understanding Securities and Various Kinds of Securities, Valuing Companies Using Various Methods, Fundamental and Technical Analysis, and lastly, we would be ending with a special case study on various legendary Indian investors and their best and worst stock picks. I hope you have a great time learning as well as experiencing. Coming to our first topic, what are securities? Securities, simply put, are financial instruments that allow the transfer of money from those who have it to those who need it. Stocks are not the only kind of securities. Securities include a wide range of financial instruments like debt, fixed deposits, and equity. Let's talk about debt. Debt is usually a sum of money that is given by one party to the other that helps the receiving party make a purchase decision that it could otherwise not make. Due to the debt that it takes on, it goes ahead with the purchase decision on the precondition that it would repay the party giving the debt after a specified period of time. The repayment does not only consist of the principal amount that is borrowed, but also an additional interest component. This is an additional interest that the receiving party agrees to bear on the debt that it takes on. The interest component serves as the primary source of income for the party giving the debt. To understand the various kinds of debt, we'll take you to be both borrower of money in the first case and giver of the money in the second case. Let's talk about our first kind of debt, collateralized debt. Now, to understand this more in detail, let's think of you as someone who wants to purchase a car. Now, you're a student who has around 2 lakhs in savings. However, the dream car that you want costs around 8 lakhs. Therefore, you have a shortfall of say around 6 lakhs. To bridge this shortfall, you approach the bank who agrees to give you a debt worth 6 lakhs at a rate of interest of 9% per annum. You take the debt from the bank and therefore you can now purchase your dream car. However, you and the bank both agree that you will repay this debt amount of 6 lakhs in a 3-year period. Now, after 3 years, you will have to repay not only the 6 lakhs that you have borrowed, but also a 9% interest component. If you calculate this on a yearly basis, this would lead to a repayment of around 6,87,000 after 3 years. The 87,000 additional that you have to repay the bank serves as the primary source of earning to the bank, the giver of the debt in this case. Now, how is this a case of collateralized debt? Now, let's think of a bad scenario. What if you are not able to pay the bank back on time? In this case, the bank has the right to sell your car to recover its dues. The car that you have purchased essentially serves as a guarantee to the bank till you don't repay the debt amount. As it's a guarantee, it's a collateral that the bank has till you don't repay this debt amount. Therefore, this is an example of a collateralized debt. Besides collateralized debt, there are 2 other forms of debt, convertible debt and non-convertible debt. To understand this more in detail, let's think of a company, ABC Limited, who wants to do a fundraising of around 40 lakhs. Let's think of you as an investor who gives ABC Limited a non-convertible debt of around 40 lakhs. Now let's get into deal specifics. You give ABC Limited a non-convertible debt of 40 lakhs for the same tenure of 3 years on a rate of interest of 12%. Now after 3 years, you're entitled to regular interest payments of around 12% on the base amount of 40 lakhs. Plus after 3 years, you'll also get your 40 lakhs back. You give ABC Limited a of around 40 lakhs. The deal that gets structured is that you give them a convertible debt of 40 lakhs at an interest rate of around 8% per annum for a period of 3 years. Now for 3 years, you're entitled to regular interest payments of around 8% on your base amount of 40 lakhs. However, after a specified period of time, you also have the option of converting this amount into equity shares of ABC Limited. Therefore, at the end of 3 years, you have the option of either getting your 40 lakhs back or converting them into shares of ABC Limited. This is an example of convertible debt, where your debt, the principal debt amount that you give, gets converted into shares of the company that you're giving the debt to as per your choice. Now let's note the key differences between non-convertible debt and convertible debt. In the first case of non-convertible debt, after 3 years, you get the principal debt amount that you give back. However, in the second case of non-convertible debt, you have an option. You can either get your principal amount back or convert it into shares of ABC Limited. This is the first difference between convertible and non-convertible debt. The second difference between non-convertible and convertible debt is that in the first case of non-convertible debt, you were entitled to a higher interest rate of 12%. And in the second case of convertible debt, you were entitled to a lower interest rate of 8%. This is essentially a compensation that you get since you do not have the right to convert it into shares of ABC Limited. Now let's talk about the main kind of security that you're going to be dealing in as part of your Finatics program: equities. Equity securities, or simply put stocks, represent a part of ownership of the company. As a holder of equity securities, you're entitled to the right to vote as well as participate in the working affairs of the company. To put it in easier terms, equity shares are simply fractions of a company that are purchased by various investors. As a virtual investor on Finletics.com, you're currently dealing in listed equity market securities. In easier words, you're dealing in stocks that are issued by listed companies. To understand equities better, let's take the help of an example. Let's continue the example of ABC Limited, which wants to raise around 40 lakhs to fund its expansion. This time, it decides to consider issuance of equity securities as the route to its fundraising. ABC Limited decides to issue around 4 lakh shares at 10 rupees each to fund this expansion. You as an investor think that ABC Limited is a sound company, and therefore you purchase around 1 lakh shares of ABC Limited. The total value of your deal would be 1 lakh shares at 10 rupees each, which means you invest around 10 lakhs in ABC Limited. By investing 10 lakhs, you get the right to 1/4 of public ownership of ABC Limited. This is the concept of equity securities, where you funded ABC Limited around 10 lakhs when it was looking to raise 40 lakhs and in return got a share of around 1/4 of public ownership of the company. Now let's talk about the key motives of equity investment. The first key motive of equity investment is appreciation in value. Now let's imagine the case of ABC Limited and take a positive side to it. Imagine ABC Limited was successful in its expansion plans. Therefore, due to the success that the company sees, the market starts valuing ABC Limited much higher than what it was valued earlier. This leads to an increase in the share price of ABC Limited from its earlier issuance price of Rs 10. As the share value of each share of ABC Limited rises, the value of your investment in ABC Limited also increases. This is the first benefit of equity ownership, which leads to an appreciation of value from your initial investment. The second major benefit of equity ownership comes in the form of dividends. Imagine ABC Limited is doing well. Since the company is performing well, it decides to distribute a share of its profits to all its shareholders. As a shareholder of ABC Limited, you would be receiving your share of this profit in the form of dividends from the company. This is the second benefit of equity securities. It's important to note that the primary objective of equity investing is appreciation in value. Therefore, all equity investors look at the potential for appreciation in value in a particular company before investing in that company. Now we're going to talk about 4 companies which have appreciated tremendously over the last 5 years and have created wealth for its investors. The first company that we are going to talk about is Shree Cements. Shree Cements was trading at around 9,280 levels in 2015. Currently, it's trading at close to 21,000 levels. This shows a 130% increase in the share price of Shree Cements, and therefore it has managed to deliver value to its investors. The second company that we are going to look at is Page Industries. Page Industries was trading at around 12,000 levels in 2015. Currently, it's trading close to 21,000 levels. Therefore, a 70% increase in share price of Page Industries has led to it creating wealth for its investors. The third example that we are going to look at is that of Eicher Motors. As you can see, Eicher Motors has appreciated close to 62% from its 2015 share price levels, thus creating wealth. The last example that I want to focus on is that of Bajaj Finance. Bajaj Finance has appreciated tremendously, close to 1,110% from its 2015 level. Therefore, an investment of around 5 lakhs in Bajaj Finance would be around 60 lakhs right now in a short span of 4 years. This is the power of equity investing.